Good morning, folks. We're going to be talking about Splunk today. A couple of these lovely companies that are really focused on data analysis. We're going to be talking about Splunk. We're going to be talking about Elastic. Today, we're starting with a little Splunk action, right? So this thing is a solid 0.81% this morning up so far. Nothing wild there. Not much movement as far as the stock's concerned. Now this one, I did preview these earnings, okay? This is one that I actually looked ahead of. Normally I do it just, on the spot. I'm like, hey, here we go. But I was busy last night, so I looked at the earnings anyways. And I must say, kind of a disappointment. Kind of a disappointment. What can I say? Splunk, let's look at these numbers, right? Quarter 2 non-GAAP EPS of negative 33 cents, which beats by 1 cent. Again, I'm more of a GAAP guy myself, and a GAAP EPS of negative $1.64, which misses by 22 cents. Not a good profitability number in that aspect. I can't lie to you. It's not what I would like to see with a company like this, right? Especially when you look at this revenue aspect, right? Look at this. 491.6 million, down 4.8% year over year, misses by 28.68 million. To see a miss on this aspect is just a absolute, just awful nightmare. I mean, in my opinion, I think that is an awful thing to see because of the fact that this is a company, and this is the whole thesis of a lot of investors' movement right now, is unprofitable companies that are growing revenue rapidly. And to see a revenue decrease here while you see a profit decrease as well, it just doesn't bode well for a stock, in my opinion. And I get the case point that obviously there's reasons beyond or for this, I guess. There's reasons, right? So you could say that for sure, no doubt about it. But we're talking about a stock trading at a market cap of $34.5 billion at this point. That likely could be lucky to bring in around 2.5 million or 2.5 billion, I should say, this year. So the valuation is quite expensive for a stock like this, with declining EPS as well as a decline in revenue. That's just my opinion. I'm looking just right off the bat, but we'll look at some of the finer data and see what we can find. So another miss here too is with guidance. They're expecting 600 to 630 million in revenue. Yikes, which is below the consensus of 639 million. Below the consensus. You don't like to see that. But you do have positives in this aspect. You do have positives. So cloud sales did show a 79% growth to 126 million. But license revenue dropped from 279 last year to 167 million this year. Yikes. So that's a big decline in terms of license revenue for sure. And again, sign of the times, I could get it. Annualized recurring revenue of 50% increase year over year, though, is positive, and you see that because of the cloud growth, obviously. Cloud annualized recurring revenue, 89% up year over year. Good stuff. Customers annualized recurring revenue over 1 million, I should say. Nothing massive there. Total 396 in terms of customers. Nothing too crazy. We do have slides to look at. So we'll talk about slides. Annualized recurring revenue is obviously a big push for them, and I think that's what's going to push the stock along. Obviously, one disastrous quarter where maybe they don't receive the payments doesn't necessarily mean much if they are going to be confident that they're going to continue this growth of annualized recurring revenue and they will make up for the revenue later. Don't know if that's necessarily the case, but we will entirely see. We will entirely see. You see the same thing from cloud. The cloud sector growth still going very strong in the 80s. So dollar-based net retention rate, good stuff here. Yeah, good stuff here. They're staying consistent. That's what you like. I mean, it's what investors are looking for, and that's why the stock didn't take an absolute hammering, in my opinion. And obviously, transitioning to a subscription model, good for them. You see overall cloud contribution to total software bookings, how much it's taken up, annualized year to date, 50% of this revenue is cloud contribution, or in terms of bookings, I should say, which is really revenue. But definitely good to see that stuff. And obviously, remaining performance obligations here, as much as what they have current activity-wise that they still need to complete. You see for this quarter they'd won $1 billion in that. You see overall 42% increase for the total quarter. If you're talking about total remaining performance obligations, but good stuff there. I mean, there's positive numbers. Again, you see a little bit of leveling off, but what you care about is this percentage growth on the top there, as far as that's concerned. So average contract duration they give in months, both from term and cloud-based. Cloud-based, you tend to see right now a little bit longer of contracts for them, which is good because the longer the contract, again, your recurring revenue obviously will grow because you're with that contract longer and you're getting payment for longer. So it is good to see on that aspect, but total combined right now, you see average contract has declined over the last year, but it's nothing to where it's a necessarily concerning amount right there. Shorter contract duration could be positive things too, technically, if you talk about labor costs. So there's positives to it. And obviously, global expansion as a percentage of revenue. Right now, from total revenues, you see 33% of the revenues are coming from international, 67% from U.S., but from cloud, it's a completely different story. 19% of revenue from cloud is international, and 81% is from the U.S., and you'd like to see that level out a little bit more, potentially, as you grow more international business. That's kind of the focus. Number of customers greater than $1 million in annualized recurring revenue. So these are the high value customers, right? So right now they've shown a 45% growth. That number is declining quite rapidly, as you see, from 85 Q2 of last year. Now 45% growth in Q2 of this year. But again, that number can't just infinitely grow technically. So nothing too crazy. On the year, they've grown 61%. But yeah, this quarter showing 45% growth. It's a good number there, you know. Overall gross margin, it's not a good thing to see. Total gross margin showing a decline. Cloud gross margin does show an increase. And again, I do think this will be the dominant segment of this company eventually. But for now, it's not necessarily the case. So total gross margin declining, not a good sign, but it's not at a concerning rate of decline in my opinion. So overall, they foresee 40% annualized growth rate, which again would be big if they could possibly do that, and they see profitability coming in fiscal year 2022. So that's again 2 years from now. Will it happen? I don't necessarily know. And by 2023, expecting around $1 billion in operating cash flow. That's rapid expectations. It's hard to see if I see that, especially with a, I don't know. I find it hard to necessarily see that. I understand it's good to think that way, and all these tech companies have been, but not a lot of them have actually been following through on this and getting to where you need to be. This annualized growth rate, it'd be good to see, but a decline this quarter, again, just puts a damper on some things. Overall, then, we look at the balance sheet as well. we look at the balance sheet, baby, they give me a 6 months comparison only. That's fine, guys. $3 billion in total current assets on this company, $2.8 billion 6 months ago. As I highlight everything, as I tend to do, because I get a little click happy. Okay. But from a total assets perspective, we see that same growth there, 5.6 billion compared to 5.4. Around a $200 million increase in terms of this balance sheet asset-wise. Liabilities, I'd like to see them shrinking to get this balance sheet looking juicy. We aren't necessarily lucky enough to see that though. So liabilities in general, total liabilities, 3.9 billion versus 3.4 billion 6 months ago. So overall stockholder equity did fall from 2 billion to 1.6 billion. I don't like seeing that. I gotta be honest with you. For a company trading at this valuation, to see a balance sheet that's not going the right direction for me, I don't really like seeing that. And the issues with obviously these flooding of convertible notes, because of the fact that they needed to raise capital. I don't like necessarily all these convertible senior notes that they're going to have to pay for eventually. And again, it's not necessarily this year, which is why it's a long-term thing. But I just don't know, with their projections, they'll be able to pay for it. But if they stay on the same path, I don't know if they'll be able to pay for it. So that's my opinion on the matter. I don't like the levels the stock's at. I really don't. Hit it with a refresh as we do. I don't like the levels the stock's at, and to find it actually in the green after these earnings is a bit of a concern for me as far as this market's concerned. Again, there was a massive drop, which I think was deserved after they reported, but to see it level out and be positive now, I can't justify this market cap on this company right now. That's just me on that matter. So again, you might disagree, and you have the right to. There's no doubt about it, but that's my opinion. Hope you enjoyed.